Thanks for joining us for the Member xCite presentation. The Member xCite presentation is informative, interesting to the audience, and showcases the strengths of the presenter as an entrepreneur and their area of expertise. It's not a sales pitch, it's a 10-minute educational and insightful exploration into what they do. And of course, it's exciting.
Ladies and gentlemen, please welcome our xCite presenter today, Glenn Newberry from Suburbanite, to present to us on good debt, bad debt, how to make it work for you. Good debt and bad debt, what's the difference between the two, and how can you make debt work for you to create financial independence without breaking the bank? In this xCite presentation, Glenn shows you how to make debt work for you to build wealth through property investing. Glenn's story is a fascinating window into the level of wealth that can be achieved by following the right property investment strategies. His own property investment experience got off to a rocky start, but soon learned the power of having a guide to pave the way for his investment transformation. As a property investor advisor at Suburbanite, Glenn is now the guide for countless people seeking to build their own successful property portfolios, inspiring people with his extensive knowledge and compelling insights. And he empowers them with his innovative strategies. Ladies and gentlemen, please put your hands together for Glenn Newberry.
So my name is Glenn Newberry from Suburbanite. I'm a property investment advisor and buyer's agent. And today I'm going to be talking to you about good debt, bad debt, and how to make it work for you. So I have been a property investor for 24 years, and I've used lots of different investing strategies to build my portfolio and help my clients build their portfolios as well. I won't bore you with the details, it's there on the page. But what I must do is tell you that I'm not a financial advisor, I'm not an accountant, I'm not a solicitor. So the information I'm giving you is just general advice today, or general guidance. Everybody's scenario is different, so you do need to seek the professional advice for your scenario. So please make sure you do that. Always recommend speak to your accountant and financial planner. Actually, one of each in the room here today, so make sure you do that. Okay, so good debt and bad debt. So there's no such thing as good debt. All debt is bad, okay? There is only bad debt and better debt, okay? All debt is bad. We don't want to have debt at the end of the day. We want to be debt-free, okay? But some debt can work for you, and other debt doesn't work for you. So what's the difference? So bad debt is debt that is used to purchase something that doesn't generate income and also is not tax deductible. That's when you need to speak to your accountant about that. Which is usually personal debt. So for example, the debt that you have on your home is personal debt. It doesn't generate income. Yes, it grows in value, the property grows in value, but it's not cash flow, it's not income. And also, generally speaking, not tax deductible, right? And also credit cards and car loans and personal loans and things like that. That's what I would call bad debt. Then you have better debt. So what's better debt? Better debt is used to purchase assets that generate income and are tax deductible, such as an investment property. Right? So that's what I would consider better debt. It's still not good debt, it's still bad debt. At the end of the day, even though I have investment properties, I still want to have no debt on those properties. And that's what I like to teach my clients how to do. My job is to share my knowledge and experience of my 24 years of investing to enable my clients to make an educated decision on what's right for them and make sure they don't make a mistake. Right? So how do you make debt work for you? Okay. So one of the things I always talk about is I always want to use the bank's money. I never want to use my own cash money. I want to keep my cash for a rainy day. Cash is king. I don't know if you've ever heard that phrase, but cash is king. You always want to keep that, and you can make that work for you as well. Don't have it in a savings account. You can have it in offset accounts that, not giving accounting advice again, but you're not making money, getting you 1% interest, but you're saving yourself 3 or 4% interest. So you're better off doing that. So the way we spend money in investing is number one, we always, or what we try to do first, is use investment equity, right? So that is equity that we have in an investment property. If you don't have equity in an investment property, then you can use equity in your home or your parents' home, which so you can use like what they call a equity guarantee to be able to do that, access their equity to buy an investment. And if you don't have any of those, then you have no choice but to use cash, okay? Cash is always a last resort, but if that's what you need to do to get yourself moving and get yourself on the investment ladder, then that's what you do. But generally speaking, always investment equity first. If you can't do that, then use equity in your home, and if you can't do that, then use cash. So what is equity? Equity is the difference between the value of your home and the amount of debt that you have on your home. So in the example there on the page, let's assume your property is worth $1 million and you have $600,000 worth of debt, then the bank owns 60% of that property, and you now have $400,000 worth of equity. Now, you can't use or you can't access 100% of your equity in your home, typically, right? So you have to use what I call accessible equity, right? So again, if we use that same example over on the next page, so if your home is worth $1 million, and generally speaking, banks will allow you to access 80% of the value of your home. Therefore, you could have a total debt of $800,000 on your home if it was worth $1 million. And if you currently have a debt of $600,000, then you have $200,000 worth of accessible equity. All right? Does that all make sense? Anyone got questions about that? I don't want to lose anyone? Okay, cool. So how do we then tap into that and use equity to purchase an investment property? So the way that that works, let's say we have a $200,000 accessible equity that we can tap into. And let's assume that we're going to purchase an investment property worth $500,000. So we tap into that equity, which is $200,000. And if we're buying a property worth $500,000, then we're going to need a 20% deposit, which is $100,000. And then we'll need around about 5% purchase costs. So that's going to cover things like your stamp duty, your pest and building costs, your legal costs. If you're using an awesome buyer's agent like myself, then it'll cover our costs as well, right? That'll all come out of the equity. So in this scenario, around about $125,000 to purchase that $500,000 property. And then what you do is you get a loan to for the remainder of the purchase price. So you get a loan it can be from a different financial institution for the remaining 80% of the purchase price, which is obviously $400,000 in this scenario. And that's how you can use that to get into purchasing an investment property without using cash. You're using personal equity in your home. You're putting that equity to work, right? If you don't invest that equity, it's what we call lazy equity. It's sitting there doing nothing. Yes, it's growing, but you're not putting that money to work, right? This is a way to make that equity money work for you, right? And put it into investment. So over the page, I then talk about equity to purchase an investment property, but in this scenario, I'm talking about using a 10% deposit, right? So you can actually, you don't have to have a 20% deposit. If you go over the 80% lending, then you'll have to pay what we call lender's mortgage insurance. Most people will. There are certain professions where they won't have to do that. Accountants are typically one of those. And solicitors typically don't have to pay lender's mortgage insurance. But for most other people, they will need to pay lender's mortgage insurance. Don't be afraid of that. It's a cost of business, okay? But what it allows you to do is make your money go further. So in that example where we had the $200,000 worth of equity, if we were buying a property, an investment property, for, again, $500,000, but we're only using a 10% deposit this time, that means we would only need around about $85,000 of that $200,000 to go and buy that same $500,000 investment. whereas before we were using $125,000, right? So it allows you to keep your equity, right? So what we can do there, and lender's mortgage insurance is just a really ballpark figure, which is what I kind of work off, and it varies from lender to lender, so it's different. But around about $2,000 per $100,000 is kind of what I work off. Would that be right, Jason?
Yeah.
That? Yeah. So it's around about $2,000 per 100,000. So it's a cost of about $10,000 on a $500,000 property. So it's still not that expensive. I mean, it sounds like a lot of money, but it allows you to keep $40,000, right? So I'd rather spend $10,000 to allow me to save $40,000 for another purchase. Okay. So then, what you could then do in this scenario is with that $200,000, we could actually buy 2 investment properties, whereas before we would only be able to buy 1, right? Because we were spending $125,000 using a 20% deposit, we wouldn't have been able to buy a second one because we didn't have another $125,000. But if you're only using a 10% deposit, then that allows you're only spending $85,000 each purchase, so you can actually buy 2 with that same $200,000. And if both of those properties grow in value, let's say they grow in value by 10%, you've made $100,000 instead of over $50,000 if you'd have only bought 1, right? So that's how you can really grow your wealth, right? By doing that and leveraging, what we call leveraging, right? So, so over the page is an example. That property is actually mine, right? So that's one that I purchased in October last year. You can see there on the left-hand side, 21st of October, I bought that one. This one's in Adelaide. I paid $485,000 for that property. And if you look down in the bottom right-hand corner, I did what we call an automatic valuation of CoreLogic, which is one of the providers of sales data, and they estimate the current value of that property at $570,000, right? And that's only in 9 months, right? So, so you can see there, I've built equity in that. That allows me now to tap into that equity and use it to then go and buy another property. Does that make sense? So if you look down at the diagram beneath that, again, using the same example, your home's worth $100,000, and then you're buying 2 investment properties initially, and then when they grow, and it's a bit hard to see the numbers there, but you're buying them for $500,000, and then when they grow to, let's say, $600,000, you've now got the opportunity to get the equity out of those and go and buy another 2 properties. And that's how you can do it to build your portfolio reasonably rapidly without too much drama. Look, there's a lot of things that you need to take into consideration when you're doing this. You obviously need to look at cash flow and things like that. You don't want to be going to properties that are costing you $100 or $200 a week to hold, because you're not going to be able to hold, or most people wouldn't be able to hold, 4 or 5 properties to do that, right? So it's a key component where you've got to look at areas that will give you growth, but you've also got to look at areas that are going to give you good cash flow to enable you to do that. Otherwise, it's just going to be costing you too much money out of your pocket, and you just won't be able to hold that number of properties. So I ran a couple of webinars which are available online. I put the web links and the QR codes. One of those was how to retire on $2,000 a week from your property portfolio, and the other one was how to pay off your home and be debt-free through property investing. Have a look at those if you're interested. They run for about 45 minutes each. And yeah, look, if you look at those and you have any questions, feel free to give me a call. My details are on the bottom there. That's pretty much it. Thanks for listening. Any questions? No? Cool, well got it. Should all be investors.
How do you go, how's your experience been with tenants, dodgy tenants?
Yeah, oh look, you do get them, but a lot of that comes down to number 1, the location you're buying in, and number 2, having a great property manager like you. Yeah, look, bad tenants quite often are a reflection of your property manager. If they're not vetting the property, the tenants, the prospective tenants, If you have a bad property manager, you're likely to get a bad tenant. Okay. Look, I've just had a problem with a property of mine in Queensland. It was set up as a drug lab, so it's just taken me 12 months to remediate that property before I can rent it out again. Don't be afraid of that. Insurance covers everything. I've got a brand new home now. It's been fully renovated, right? So they have to basically rip out all the electrical appliances because they've all been contaminated. Brand new air conditioners, ovens, cooktops. Have to repaint everything, all new blinds. Everything is new. The floors. They even ripped up tiles in the foyer and replaced tiles. I have no idea how tiles can get contaminated, but that's what they did. So yeah, look, it hasn't been rented out for 12 months, but we get paid rental income for that because we had a lease. And but look, and I do think that was a bit of the property manager because there were signs, and the property manager didn't act on those. So look, to me it's more about, look, you'll get it, sometimes it happens, but to me it's more about, number one, the location you're buying in, and number two, making sure you have a good property manager. Yeah.
In saying that, where do you look for properties at that 500,000?
There's an
Talk to
example.
me.
Yeah. Sorry?
How would you find them? How would you go about?
I mean, you can look on real estate.com. I mean, we do a lot of research, right? Our job is to research locations, and it's not just about, I can buy a $500,000 property there. It's about understanding what's going on in that market that's going to drive the growth, right? So that's why I bought in Adelaide. I have 2 properties in Adelaide, and they've gone exceptionally well. Both from, Adelaide's a really unique market at the moment, where usually with property, you'll get price growth and rents will be stagnant. And then when the price stops growing, then you'll get rental growth, right? So they kind of work opposite to each other. Adelaide is really unique at the moment where you're getting this happening. You're getting both. You're getting growth and you're getting rental growth, right? So
rental prices are going up like $70 to $100.
Yeah. Well, that particular property there, when I bought that in October, it was rented out for $400 a week, which was probably a little bit low. Should have been probably about $420. The lease came up for renewal in March, so I've only owned it since October. Lease came up for renewal in March, and the agent rang me up. Remember the initial rent was $400 a week. The agent rang me up and said, we recommend you put this rent up to $480 a week. That's a 20% increase in rent. Like, how many tenants would want that? So we went back to them and said, no, we don't think that's fair on the tenant. And they've been a good tenant, for the period that we've owned it. And we offered them $450 and they snapped it like that. Because Adelaide has the lowest vacancy rate of any capital city in Australia at the moment. And that's what's driving the rents. That's driving the rents up. And of course, as time goes on, investors are getting hold of that, and investors going into the market, driving the price. It's not driven by investors, it's driven by owner-occupiers. But certainly there are investors going into that market. Perth's another really good market at the moment. It's coming into its growth phase. So you can buy properties for a similar price in Perth as well. Just you've got to be careful of locations. Anywhere you buy, you need to be careful of locations. You can go and buy a property in Adelaide for probably just over $300,000. I wouldn't recommend it.
No.
You can certainly do that. That'll be in a location called Elizabeth.
Yeah.
Any suburb that starts with Elizabeth in Adelaide, don't buy them. And that's where you'll get your issues with your tenants, right? So it's typically lower socioeconomic area, a lot of housing commission in those locations. That's not a location I want to put my clients into. Just because it creates headaches, right? So you just don't want that. Pretty much it.